However, the picture isn't uniformly rosy. While there are modest gains across the board in the equity futures, the volatility index, a key barometer of market fear, has surged quite noticeably. This divergence suggests a market grappling with conflicting signals, an eagerness to bid up certain assets, juxtaposed with a palpable unease about the broader economic landscape and future policy directions. It's a classic case of a nervous rally, where investors are making moves but simultaneously seeking protection. The narrative for today will undoubtedly revolve around understanding this underlying tension. We'll delve into the forces driving these early moves, from shifts in central bank leadership to significant developments in the commodity and digital asset spaces. The stage is set for a day rich with interpretation and potential market re-evaluations. The financial world is abuzz with the impending confirmation of Kevin Warsh as the new Federal Reserve Chairman. This isn't just a personnel change, it signals a potentially profound shift in the very fabric of U.S. monetary policy. Barron's recently highlighted that Warsh's confirmation process itself is expected to be contentious, suggesting the deep divisions and high stakes involved. The consequences of this leadership transition are far-reaching. Warsh is known for his hawkish leanings and a strong belief in market-based solutions, which could usher in an era of tighter monetary policy, a renewed focus on inflation targeting, and a more hands-off approach to quantitative easing than we've seen in recent years. Further compounding the pressure on the Fed is a startling report from Al Jazeera, indicating that the U.S. Treasury Secretary has declined to rule out future lawsuits against the Federal Reserve. This is an unprecedented challenge to the central bank's independence and its traditional role as a non-political entity. Such legal scrutiny could severely limit the Fed's operational flexibility and introduce an unpredictable element into its decision-making process, especially under a new chairman trying to establish his authority. Jamie Dimon, a prominent figure in finance, has previously warned against such political interference, only to have his concerns dismissed by others, including former President Trump. This ongoing tension between political oversight and central bank autonomy adds a layer of systemic risk that market participants cannot ignore. The outcome of these pressures will undoubtedly shape the credibility and effectiveness of the Warsh Fed from day one. Beyond Washington, other voices are also shaping the market discourse. Ray Dalio, the billionaire investor, has dropped a blunt message on gold, an asset currently experiencing a robust rally. His views often carry significant weight, influencing how institutional money perceives safe haven assets. Meanwhile, Michael Burry, famously known from The Big Short, has issued a stark warning that Bitcoin might be poised to repeat its dramatic 2022 collapse pattern. This comes at a time when the digital asset market is showing signs of renewed vigor, creating a fascinating contrast between current price action and the warnings from seasoned skeptics. These powerful voices underscore the deep uncertainty and divergent opinions prevalent in today's complex financial environment. The bond market, often the most prescient indicator of future economic sentiment and monetary policy, is flashing important signals this morning. We're observing a notable decline in the yield on the 10-year U.S. Treasury note. This dip in yields, despite the general upward trend in equity futures, speaks volumes about the underlying anxieties concerning the economic outlook and the future direction of the Federal Reserve under its new leadership. One significant factor contributing to this decline appears to be the recent U.S. job openings report, which revealed a 5-year low in December. This data point from The Guardian paints a picture of a softening labor market, suggesting that inflationary pressures from wage growth might be easing. A weaker jobs market often translates into expectations of less aggressive monetary tightening, or even potential easing down the line, which typically pushes bond yields lower. Furthermore, the broader narrative of Federal Reserve policy coming under pressure amid rising layoffs, as reported by Global Banking and Finance Review, directly feeds into this dynamic. With a new Fed chair in Kevin Warsh, the bond market is essentially pricing in a complex interplay of a potentially hawkish new regime facing a weakening economic backdrop. Will Warsh prioritize battling inflation even as the economy slows, or will he be forced to temper his stance to support growth? This is the central question the bond market is trying to answer, and for now, it seems to be leaning towards a scenario where future rate hikes might be less certain or even less aggressive than previously anticipated, especially if economic data continues to soften. The falling yields could also reflect a flight to safety, as geopolitical uncertainties persist and the VIX shows rising anxiety, making government bonds an attractive haven despite lower returns. This movement in the 10-year yield is a critical piece of the puzzle, as it influences everything from mortgage rates to corporate borrowing costs. A sustained downtrend in yields could provide some relief to interest rate-sensitive sectors, but it simultaneously signals a cautious outlook on the strength and resilience of the U.S. economy moving forward. The global central banking landscape is navigating a period of immense change, with all eyes firmly fixed on the United States and the transition to the Kevin Warsh era at the Federal Reserve. His confirmation, as Barron's highlights, will be messy, reflecting the profound ideological divide over the Fed's role and monetary policy direction. A Warsh-led Fed is expected to pivot towards a more orthodox, inflation-focused stance. This means a potential re-evaluation of current liquidity provisions, a more stringent approach to asset purchases, and a clear signal that the era of ultra-accommodative monetary policy is firmly in the rearview mirror. The implications are significant. Higher borrowing costs could become the norm, credit conditions might tighten, and the market could face a prolonged period of adjustment as it recalibrates to a more hawkish central bank. However, Warsh will also inherit an economy where job openings have dropped significantly, as The Guardian reported, and where the Fed's policy is already under pressure amid rising layoffs. This creates a challenging dilemma. How aggressively can he pursue an anti-inflationary agenda when the labor market shows signs of weakening? The interplay between Warsh's hawkish tendencies and the incoming economic data will define his early tenure and, critically, market expectations. The declining 10-year Treasury yield we discussed earlier could be an early market signal of this anticipated balancing act, as investors factor in both the potential for higher rates and the challenges posed by a softening economy. Looking internationally, the broader picture from other major central banks offers a contrast of stability. The European Central Bank, according to its latest monetary policy decisions, has maintained its interest rates, signaling a wait-and-see approach as it assesses inflation trends and economic growth within the Eurozone. Similarly, the Bank of England has kept UK interest rates on hold at 3.75%, as reported by the BBC, indicating a cautious stance amidst their own inflation battles. Even in Asia, India's central bank decided to keep rates on hold following a US trade deal, as Reuters informed us, suggesting a global trend of central banks preferring to maintain current policy settings while closely monitoring developments. This global stability underscores the unique and pivotal position the Federal Reserve is in, with its upcoming leadership change poised to create the most significant policy divergence among major economies. The financial world is holding its breath, anticipating how the Warsh Fed will chart its course amidst these complex domestic and international crosscurrents. The commodity markets are painting a compelling picture this morning, reflecting a mix of robust demand signals and underlying supply dynamics. Gold, often seen as a traditional safe haven asset and inflation hedge, is experiencing a strong rally. Its price movement suggests a renewed appetite from investors seeking refuge amidst the broader market volatility indicated by the rising VIX, and perhaps anticipating inflationary pressures or geopolitical uncertainties. The current upward trajectory follows a period where gold's role as a store of value has been reinforced, as highlighted by Fortune, prompting investors to increasingly flock to the precious metal. Billionaire Ray Dalio's recent blunt message on gold, though not fully detailed, likely resonates with this sentiment, advising caution or endorsing its defensive qualities in uncertain times. In the energy complex, crude oil futures are also moving higher. This upward momentum comes despite reports from oilprice.com suggesting that oil prices were set for their first weekly dip of the year. The current rally in futures could signal a rebound in demand expectations or renewed supply concerns outweighing recent bearish sentiment. Geopolitical tensions, or even anticipation of stronger global economic activity, could be contributing to this upward revision in prices, as traders look beyond immediate dips to longer-term fundamentals. The global energy picture remains finely balanced, with any shift in demand or supply having an outsized impact on prices. Conversely, natural gas futures are dipping this morning. This move is particularly interesting given the U.S. Energy Information Administration reported record natural gas stock withdrawals for the week ending January 30, 2026. Typically, significant withdrawals would imply stronger demand, which could push prices higher. However, the current decline suggests that either the market has already priced in these withdrawals, or that milder weather forecasts, robust production, or shifting industrial demand are creating an oversupply perception despite the inventory drawdowns. This illustrates the complex and often counterintuitive dynamics within energy markets, where futures pricing incorporates a multitude of variables from weather patterns to storage levels and geopolitical stability. Each of these commodity movements offers crucial insights into the market's perception of global economic health, inflation risks, and geopolitical stability. Turning our attention to specific sectors, the technology space is exhibiting a fascinating dichotomy this morning, even in the absence of an open US market. While some of the titans are retreating, others are showing remarkable resilience, indicating a nuanced narrative rather than a broad-based tech sell-off. Nvidia, a bellwether for the artificial intelligence boom, is seeing its shares ease back. This could be a reflection of profit-taking after its incredible run, or perhaps a re-evaluation of the AI narrative following comments from its CEO, Jensen Huang, who reportedly dismissed the idea of AI replacing software as illogical. While not inherently negative, such statements can sometimes temper the most exuberant expectations. Similarly, electric vehicle pioneer Tesla is also trading lower. This movement could be influenced by broader market jitters, or perhaps a reaction to the various narratives surrounding its visionary CEO, Elon Musk, including his cryptic messages about wealth or the intriguing whispers of a massive AI and space megamerger reported by the Wall Street Journal. Both companies often see their stock movements tied closely to the perception and pronouncements of their charismatic leaders. Meanwhile, other tech giants like Microsoft and Amazon are experiencing more substantial declines. These significant pullbacks could point to broader investor concerns about valuation multiples, potential shifts in corporate spending, or perhaps a rotation out of some of the highest-flying names as investors become more risk-averse, as suggested by the rising volatility index. On the other hand, Apple is showing resilience, posting a modest gain. This could be attributed to its robust ecosystem, consistent consumer demand, or perhaps the market finding a defensive quality in its steady cash flows amidst broader uncertainty, even with Mark Zuckerberg continuing to blame Apple for Meta's problems. Google is also moving higher, demonstrating a similar strength. The stability in these names might suggest a flight to quality within the tech sector itself, favoring companies with stronger balance sheets and more predictable revenue streams during periods of uncertainty. Meta Platforms, surprisingly, is holding relatively steady, showing minimal movement. This could indicate that investors are waiting for clearer signals, or perhaps that the stock has found a temporary equilibrium after recent volatile periods. The mixed performance across these tech giants underscores the importance of company-specific fundamentals and narratives, even within a sector that often moves in unison. This selective performance suggests a more discerning market, carefully picking winners and losers based on perceived value, future growth prospects, and resilience against macroeconomic headwinds, all while navigating the underlying currents of rising market volatility. The digital asset space is presenting a compelling, yet complex, narrative this morning. Bitcoin, the flagship cryptocurrency, is rallying quite strongly, pushing towards the significant psychological milestone of $65,000. This upward momentum is mirrored by Ethereum, which is also enjoying a substantial climb. These movements suggest a renewed optimism within the crypto community, perhaps driven by institutional adoption, ongoing demand for spot exchange-traded products, or a weakening dollar outlook. However, the story gets much more intricate when we look at MicroStrategy. Despite Bitcoin's robust performance, MicroStrategy's stock is experiencing a sharp and significant decline. This dramatic divergence highlights the critical distinction between holding the underlying asset and investing in a highly leveraged corporate entity that primarily holds that asset. MicroStrategy has famously bet big on Bitcoin, and while that strategy has yielded immense returns at times, it also exposes the company to magnified downside risk. News headlines such as MicroStrategy faces catastrophic risk as Bitcoin falls to $60,000 from Yahoo Finance, and Bloomberg's report that Saylor's crypto project pounded after $12.4 billion loss provide crucial context. These headlines, likely reflecting earlier price action in Bitcoin or the cumulative effect of past downturns, suggest that the market is reacting to MicroStrategy's inherent leverage and the perception of its risk profile. Even if Bitcoin stages a daily recovery, the market remembers the volatility and the company's substantial losses incurred during previous downturns. The market is pricing in the structural risk associated with MicroStrategy's strategy, where its fortunes are intrinsically tied to the volatile swings of Bitcoin, amplified by the company's borrowing to acquire more. This makes it particularly sensitive to any downturn, even if temporary. The cautionary words from Big Short investor Michael Burry, warning that Bitcoin may repeat its 2022 collapse pattern, certainly add a layer of skepticism for institutional investors, even as retail enthusiasm for crypto waxes and wanes. The implications here are profound. While Bitcoin may be finding its footing, the market is signaling that not all exposure to digital assets is created equal. Corporate strategies that heavily leverage volatile assets carry unique and significant risks that extend beyond the immediate price action of the underlying cryptocurrency. As we look towards the US trading day ahead, with markets eventually opening later, investors will be processing a confluence of powerful signals from the overnight session. The most critical factor dominating sentiment will undoubtedly be the ongoing narrative surrounding the new Federal Reserve Chairman, Kevin Warsh. The market will be actively dissecting any fresh commentary or indications of his policy leanings, particularly regarding inflation, interest rates, and the Fed's balance sheet. Any clarity or perceived ambiguity from the new leadership could trigger significant shifts in bond yields, equity valuations, and currency markets. Furthermore, the bond market's current disposition, characterized by falling 10-year yields, bears close watching. Will this trend persist once US traders are fully engaged, or will there be a reversal? This will largely depend on how investors interpret the recent economic data, particularly the softening job market figures, in the context of a potentially more hawkish Fed. In the commodities space, the resilience of gold and the rebound in crude oil futures will be key indicators of global sentiment. Are these moves sustainable, or will they face headwinds from profit-taking or shifts in broader risk appetite? And the intriguing divergence in the crypto market, where Bitcoin rallies while MicroStrategy falters, will continue to be a focal point. Investors will be keen to see if this disconnect narrows or widens, offering insights into how the market prices both the underlying digital asset and the leveraged corporate plays on it. The VIX's elevated levels suggest that volatility is likely to remain a significant feature of the day, with investors remaining cautious and ready to react swiftly to any breaking news or shifts in economic data. Expect a dynamic and potentially sensitive trading day, where the underlying narratives around central bank policy and economic stability will dictate market direction. As we wrap up our morning briefing, the overarching theme emerging from the overnight session is one of transformation and tension. The financial landscape is poised for a significant pivot under the new leadership of Kevin Warsh at the Federal Reserve. His tenure promises a recalibration of monetary policy, likely towards a more hawkish stance, but this will unfold against a backdrop of a softening labor market and unprecedented political pressure on the Fed's independence. This fundamental shift in central bank philosophy is the gravitational center pulling on all other market movements. We see this tension reflected vividly across the markets. In fixed income, declining yields are signaling a cautious economic outlook, perhaps anticipating that a more hawkish Fed will nonetheless be constrained by real-world economic conditions. In commodities, gold's strong rally underscores a flight to safety and concerns about inflation, while oil's rebound suggests a complex interplay of demand and supply dynamics. Even natural gas, with its counterintuitive dip amidst high withdrawals, speaks to market forces re-evaluating supply-demand balances. Perhaps most tellingly, the crypto corner illustrates the profound disconnect between asset performance and corporate risk. Bitcoin's current surge is compelling, but MicroStrategy's sharp decline on similar news serves as a stark reminder of the perils of leveraged plays. It's a powerful lesson in understanding the layers of risk. The modest gains in equity futures, coupled with a surging volatility index, further reinforce this narrative of a market in flux, eager for opportunity but deeply wary of the underlying uncertainties. Today, and in the weeks to come, the focus for astute investors must be on deciphering these complex narratives, understanding the why behind the moves, and positioning for the profound implications of this new era in global finance. Thank you for joining me.